Okay, so today we're going to be looking at mortgages. So we're looking at the do's and don'ts, the central bank lending limits, the application process, and the banks versus brokers. We're all going to have a look at subprime mortgages and what they are. Okay, so the first part we're going to look at is the do's and don'ts. Now, there's a number of things you can do that can hinder your application. There's also a number of things you can do that can help it. So let's have a look at them now. Okay, so the do's. So first things first, you need to be saving on a regular basis. Now, obviously, you're going to be saving for a deposit anyway, but even if you've already reached that, the bank are going to want to see that you have the capacity to save. There's also a formula in the different lenders use which looks at how much money you have left over after you've paid your mortgage and paid your standards bills. It's the disposable income level. So we can have a look at that in later videos. The other thing as well is make sure that your wages are paid directly into your bank. Ideally, if you can be banking with the lender that you're going with. So for example, if you are with ABC Limited, the Bank of ABC Limited, and you want to get a mortgage, it would be great if you go to ABC Limited to get your mortgage. Now, not necessarily anything you have to, but it is handy when lenders can just simply click in and they can see access to your account straight away rather than you bringing in statements. It can be done either way, but just suppose this process just makes it a little easier. So one of the most important things of all in terms of not to do is do not, under any circumstances, use your credit or debit card to top up any bookmakers. So this might be, I won't mention them by name, but any horse betting or any casino or any of those type of services, even if you use the card in a land base. So if you walk into a physical casino or a physical bookmakers, anything that shows up on your statement that resembles that is an immediate red flag. The idea behind it is that lenders will look at this and say, well, look, you're willing to gamble your own money, so perhaps you're willing to gamble our money. In other words, the money that's due to be paid on the mortgage. It's just an immediate red flag. So, I don't want to advise how to do that, but the main key thing is, keep it all off the card. That's the most important thing of all. The other thing as well is don't take out a loan for the deposit, because what can happen is when you take out a loan, it goes on your credit report. It says this person owes so many thousands, this person owes so many hundred thousands, or whatever it might be. So they look at your loan and look at how much you owe. Now, if you take out a loan of €40,000 to help towards your deposit, when you go to your lender to get your payment, they'll effectively look at that and say, look, you owe €100,000 or you owe €40,000 on your loan, therefore you're paying €250 a month or €200 a month, whatever it might be. They'll look at that and say, okay, we can only lend you X amount and you have less going out, so therefore it reduces the amount of money that you can borrow. So it's kind of a catch-22. On the one hand, you need to have money for deposit. On the other hand, you want to be able to have the lend capacity to be able to be borrowed to. So that's kind of one thing to bear in mind. Okay, so this is the continuation of the don'ts, because there's so many don't put on the page. So one of the things you definitely don't want to do is take out a credit card in the months leading up to your application. The reason being that if you have a credit card with, say, for example, in this example, we have Bank XYZ Limited. If you have a credit card with them and you owe 5,000, you can potentially owe €5,000. Your credit card says your available balance is €5,000. As far as the lender is concerned, you owe €5,000 because you could theoretically go out to a shopping center and rack up a debt, or go out anywhere and rack up the debt of 5,000 in one day. It is possible. So because of that, they regard that 5,000 as credit as a debt. So it would further reduce the amount of money that you have available. Where possible, either if possible, get rid of the credit card. The key thing is that once you have the mortgage in place, once it's drawn down, once the payments are going through, from there on in, you could get a credit card. You could do anything thereafter. It's not as stringent. I suppose the key thing is just getting the mortgage. Once you have it, then you're, I suppose, free to make other decisions in a less complex way. The other thing as well is try not to miss any payments on your loans or even your rent. If you can show that you're consistently paying your rent on time every month, and you're showing that you're not in arrears, and you're showing that you have the correct payment capacity, that goes a long way towards lenders. But they'll look at it and say, if this person is looking to borrow money and pay back $1,300 a month in a mortgage, or they might even look and say, look, you're paying $1,500 a month in your rent, so you're going to be paying $1,300 in your mortgage, so obviously obviously you can afford it. The other thing as well is periodically check in with utilities, gas, and toll. Now, this is one of the important ones. If, for example, somebody, let's say you were living at one address and you moved, and either the new owners, the new tenants took over, and you didn't necessarily transfer the gas bill or the electricity bill, what can happen is, and I've seen it happen before, is where the bill doesn't transfer to your name straight away. It transfers somebody else's name a month later. And what happens is, for that short window, even if there was no gas or electricity used, there's still a standing charge. And it might only be 30 or 40 euro. But as far as the lender, as far as the utilities company is concerned, you still owe that money. Now, if you've moved address or if you've moved phone number or anything like that, and they can't get in contact, that will stay on their books, and eventually it will go to a collections company who will try and collect it. And if they can't after numerous times, it then goes to a court appearance. Once it goes to court, then you have what's known as a CCJ against you, and then effectively by having that then goes against your credit rating. So it's just handy enough. I mean, it might only be a case if you ring up an electricity company and say, yeah, sure, no problem, we have that here from the last time you moved house and you owe 20 euro. Great, you pay it off, done, happy days. So the last thing you want to do is have any impact on your credit rating. So that's just one of the more important things to look at. Okay, so now we're going to look at the central bank lending limits. So the key thing here is, and I've underlined it for this reason, lending limits are based on gross earnings, gross. So a lot of people think, well, this is how much I get, 40,000 euro pre-tax, and then I pay universal social charge, PRSI, and then I can deduct tax deductions for my childcare and this and that and the other. It's gross. It literally is the amount of money you're earning gross. So here we have a typical example of a couple who were wanting to get a mortgage. So if person 1 earns 40,000, person 2 earns 40,000. Nice and simple, 80,000 euro. So the lending limits of the central bank is 3.5 times your gross earnings. So in this case, 3.5 times your 80,000 is 280,000. Now the other thing as well is, a couple of years ago, back around 2017, the central bank made some changes to deposits, and it was initially kind of misunderstood by a lot of people. And I think to some degree, some people still think it's the 20% rule. But actually what it is it's the 20% kicks in after 250, and I'll explain that in a second. So what happens is, let's say, for example, you want to buy a house and it's 270,000 euro in this example. So the first 250,000 euro is 10%. So we say 10% of 250,000 euro, and then 20% of any money remaining. So as you can see below here, you want to buy a house 270,000, and the deposit required is 29,000. Now, how do we come to that? Well, we took 10% of 250,000, 25,000, then 20% of the remaining 20 grand left over, because obviously 20,000 plus 250 is the 270, and then 20% of that 20,000 is 4,000. Add those two figures together, and we come to 29,000. So again, it can make a huge difference, because if, for example, you're thinking that you need to have 20% of the 270,000 euro, then you might think, well, I don't have that yet. I'll keep saving and I'll come back to it later. You might miss the opportunity to buy a house at the appropriate level, and you might have the available funds. So it's just one of those things to bear in mind. If the property is under 250,000 euro, you only need 10%, and anything after the 250,000 euro is 20%. So that's kind of one of the important things to bear in mind. Okay, so let's have a look at the application process. So you're going to be contacting a lender, which is typically a bank, a broker, or an intermediary. The lender will go through some pre-qualifying questions. Effectively, how long have you been working? Do you have a P60? Do you know of any issues with your credit report? Effectively, they're just kind of assessing how eligible you would be for a mortgage, because they get so many applications every day. They want to kind of process the right ones. And I suppose the other thing to remember is that the broker only gets paid when the mortgage is drawn down. So from their point of view, they're effective. We want to make sure that you're the best possible candidate for them to work with. So the other thing is, depending on whether you're with a broker or with a bank, they'll go through a different range of different options. So for example, if you wanted a 10-year fixed rate and you go to a bank and they don't have that particular product on offer, then they might kind of go through your options and look at it and say, well, maybe a 5-year rate might be suitable, or what, a 5-year fix. But again, that's I suppose the difference between a bank and a broker. A bank can only sell you a product based on what they have on offer. Obviously the broker is the same, but the difference is the broker has access to many banks. So for example, one broker might have access to 40 or 50 different banks, and within that there might be 40 or 50 different products. So there could be hundreds of different options. You might have a fixed rate, you might have a variable, you might have fixed for 5 years, then a variable, you might have variable initially, then fixed, for, or whatever it might be. You might have some mortgages years ago had the option where you could chip away at it. So you could pay, your standard mortgage each month, and if you had a little bit extra when you got bonuses or whatever, then you could pay that off as well. So I suppose it kind of gives you different options in that regard. So the other thing to look at then is that either the broker or the lender or the bank will effectively look at your application and they'll make sure everything's in order, and they'll also be requesting a salary certificate from your employer. Okay, so we're going to have a look at next is bank versus broker. So the main difference between a bank and a broker, as we mentioned before, is that the bank can only sell you products that they specifically have, whereas a broker can get you access to many different products. I suppose one of the other differences with a broker is that if, for example, you had a bad credit history going back 2 or 3 years ago, a normal lender, the bank, a typical bank, won't be able to help. They generally go by the ICB, the Irish Credit Bureau, which means that if you have any bad credit history, it generally stays there for 5 years. So the key difference then being that with the broker, they would have access to lenders who would be able to give you a mortgage if you had only defaulted, say, 2 years ago. So I suppose but the key difference is that those particular mortgages would be referred to, as you may have often heard in the news, referred to as subprime. More detailed look at that in a second. So for example, if you one of the kind of suppose impacts of if you had a bad credit history is that you wouldn't be able to get a loan from anywhere. If you went to a pillar bank or any bank and said, I want to get an overdraft, a car loan, a mortgage, you just would not be able to get it. And the reason being that they look at the credit bureau, they say, look, this person had a loan, they've defaulted on it, and they haven't paid back that small loan. Well, what are the chances that they're going to pay back this 150 or 200,000 euro loan? So that's what they look at. So I suppose that's one of the things to bear in mind. The other way, I suppose, I find easiest to explain to people when they're asking what's the difference between a bank and broker. Well, the easiest way is, let's say, for example, you're in a shopping center and you see one restaurant and you think, well, I can look at the menu of that one restaurant, or I can go down to the food court and I can look at multiple menus. And that really is the simplest way. You go to one bank and they can only tell you what's on the menu there, or you go to the food court and the broker effectively says, here are all the options available, all the different cuisines, all the different options available. So I suppose that it really is kind of the easiest way to explain the difference between a bank and a broker. Okay, so now we're going to have a look at subprime mortgages in more detail. So for this example, we're looking at Joe, who took out a car loan in 2016. He fell behind on his payments, and unfortunately in September of 2017, his car loan was defaulted. So since then, Joe has actually paid off the loan, but on his credit rating, it shows as written off cleared. So if he hadn't paid it at all, it would just be written off, but it's written off cleared. So that's good in a way that he's paid it back, but unfortunately, because it's defaulted, it means that it's going to be on his credit report. So a credit report will generally be there until the end of the month of whatever month it was, and 5 years. So for example, if he defaulted on the 1st of September 2017, it will be removed on the 1st of October 2022. Now what that means is Joe can't get an overdraft, he can't get a loan, he can't get a mortgage, he can't get a credit card because of all the way all the pillar banks do. However, in the case of subprime mortgages, he can, in some cases, get it. Now, obviously, he has to be working, he has to have his P60, he has to have all the other details as well, have to be in place as normal. It's just the only different issue that Joe is facing here is his credit rating. So, for example, if we look here, so Joe says he applies to a subprime lender for a loan of €100,000 over a 20-year term, and then he wants to buy an apartment. So Joe's approved, his loan is drawn down. Now the key thing is drawn down at about 4%. Now I'm not saying all subprime lenders are 4%, but they're generally a rate that's higher than the normal lenders. The suppose are the standard lenders of normal banks. And the key reason why it's higher is because they feel that they're taking a higher risk because it's somebody who had a bad credit history. Now you might say, well, I don't want to be paying 4% on my interest. I don't want to pay the higher range of interest. I'll just wait until the 5-year mark. Well, a couple of things to look at there. If you wait till the 5-year mark and you say, well, look, I'll wait until I get to the point that my credit is in good scoring in 2022. A couple of things there. First things first, during those 3 years, you're going to be paying rent, which goes straight down the drain, and that's it, never to be seen again. And as well as that, property prices may, in that certain time, be going up and up and up, and then you rule yourself out of the option of getting one. So in this instance, Joe takes out his mortgage, he takes out his loan, he gets the mortgage at 4%, and he's paying €605 a month. So then Joe's continues to be in employment and then in November of 2022, after it's all cleared, done, dusted, he applies to a normal bank, a pillar bank, and switches his mortgage over, and now it's at a standard variable at 2.5%. Now, obviously, I don't know what the rates will be in 2022, but the standard variable is 2.5% at the moment, at the time of filming. So Joe's mortgage, his new mortgage, is €93,000 because in the last 3 years, based on the rate that he was paying, he has paid money off the mortgage, and now he only takes out a mortgage for €93,000. And bear in mind, he already owns the house, so he doesn't have to raise a separate deposit. He doesn't have to go off and get a deposit. He doesn't have to get it. He may have to pay a small fee to a solicitor to change the papers over, and that's about it. So now Joe is paying €492. And Joe continues paying that until the next 17 years until it's paid off. So in this example, you can see where people might necessarily look at a subprime and think, oh no, I don't want that. I don't want to pay the higher rate. But at the same time, you pay the higher rate, and in a couple of years' time, when your credit rating is back on track, you switch over to the other bank. And it seems like a fairly logical approach, because otherwise you're going to be paying rent for a longer term. And because you're paying rent for a longer term, then that money is effectively gone. You pay rent, it's gone. You pay a mortgage, okay, you're paying a slightly higher rate, but you're protect. Obviously, in that example on the 100,000, it's at the amount that it is. But I suppose the key thing to remember here is you're paying something off the mortgage. You're in a home that is potentially getting in value. Now, obviously, I'm not saying to everybody they should do this, but this is an example of how it would be a good idea if you were in that particular situation. Applies for a subprime lend, doing it shows off